Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, you hit Eco Go on your Bloomberg terminal and you see a lot of economic data coming out today. I don't know. One of the ones that kind of jumped out at me is this GDP annualized quarter to quarter. The forecast was for a decline of 0.2%, came in a decline of 0.3%. That's versus a gain of 2.4% last period. That kind of gets my attention. So we said, hey, let's ask Michael McKee. He does this stuff for a living, international economics and policy correspondent for Bloomberg News. He joins us here in our studio. Mike, is that a big deal, that number, that print?
Yes, it's a big deal, but not for the reasons you might think. And
okay.
I'm going to say something you've never heard me say.
Oh, what?
That Matt Miller just accused me of. He said I sound like Peter Navarro today. Yeah, I see. Did you see Alex's face when I said that?
My face bugged on that a little bit.
Because I agreed with what Navarro's sentiment was on television a few minutes ago, where he said that this was not a bad report. I'm summarizing, because the 0.3 decline doesn't tell the whole story. I mean, the story underneath GDP today is all tariffs. What happened? We saw tariffs tariffs get people to import a lot of stuff to try to get ahead of the tariff price increases, and that has totally distorted the numbers here. What we've seen is that imports subtracted 5% from GDP, a record. Inventories added 2.25% because the jump in inventories was a record during the month, and they didn't quite offset, but we did see all of this distortion in the numbers that doesn't tell you the real story. If you look at consumer spending, it was up 1.8%, which was a little more than expected. And business spending, distorted by tariffs, up 9.8%.
Oh, wow.
22.5% gain in imports of equipment. So it's really hard to tell. So what you do if you're an economist is you look at real final sales to domestic purchasers, which takes out inventory and trade, and that was up by 2.3%. It's a little lower than it was in prior quarters, but that is still showing growth in the overall consumption economy.
Well, to that point, if we are seeing consumption okay, and now we have incomes being okay, is consumption also being driven by pre-buying tariffs, or is this real underlying strength?
No doubt, because people bought a lot of cars.
Okay.
And they've bought,
or at least
they bought other things that we didn't see a big increase in durable goods spending, but there was a big increase in services spending, a relatively big increase. So Americans were out spending money. Now the question is, where do they go from here? And for that, what you're looking at is the other data we just got at 10 o'clock, which is the PCE data.
Is this the one we care about, or is this not the one we care about?
This is the one we care about.
This is the one we care about.
That's what I thought.
This is the monthly number. So it's the most recent data. This is, if you're following the trend, which is what the Fed wants to do. We were up 0.7%, which is up from 0.5% in February. So Americans spent more in March. The numbers were weighed down by what we got in January and February in the quarterly numbers. And incomes were relatively strong. They're still up 0.5% after a 0.7 rise the month before. If you look at the wages and salaries in that report, which is the most important thing because people spend what they make, they were up 0.5%, which was up from February's 0.4 and January's 0.2. So as the month went on, people got more money. They spent more money. And so it doesn't suggest we go into the second quarter with a real problem in terms of consumer momentum.
That's my read. It seems like the consumer, Mike, is still pretty good.
When you're looking at the consumer confidence numbers, it looks really terrible. But the numbers that we're seeing from consumers in terms of what they do, rather than what they say.
And that's what Treasury Secretary Bessent's been saying. I mean, you can look at all the survey numbers you want.
Sounding like Bessent along with Navarro.
Yes, exactly. But I mean, that's what he's been saying. He's saying you can look at all the sentiment data you want, but people are still out there spending money.
Well, the question now
this is
becomes...
still backward looking. I mean, this is still for March. April was when we saw the tariff headlines and the volatility in the market, right?
Yeah, the PCE numbers are March that I'm talking about, and the rest of it is first quarter through the end of March. So what's happened in April? That we don't know yet. We're going
All
to
we have is the sentiment.
We're going to have to see. We have the sentiment indicators, and March was really the first month when there were any tariffs, and they weren't really tariffs on you and me. They were tariffs on the steel companies and things like that. So if people are paying more for what they're getting, if they can get anything from China now, maybe that does affect what they're going to be spending on. So somebody said to me this morning, this makes the Fed's job harder because you had higher inflation and lower growth, but I think it makes it easier. It just cements the case for doing nothing because this report is so distorted by the tariff stuff that it's impossible to say what it's going to mean going forward.
Such a good point. He's so smart. That's why we get him on, talking about all this stuff.
Yeah, it sounds just like Peter Navarro.
Yeah, samesies. It's totally the same. Michael McKee, Bloomberg International Economics and Policy Correspondent, joining us in studio. Thank you so very much.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. Want to get an update here on Supermicro. The stock gets hammered here after preliminary earnings results that fell well short of analyst estimates. Remember, this was a darling that went into the mid-cap stocks and had lots of issues with kind of revamping its accounting, et cetera, and they were trying to really find their footing. Jin Ho is Bloomberg Intelligence Senior Technology Analyst, joins us now. They're trying to find their footing that maybe pushed back a bit. What happened in their preliminary announcement?
Yeah, hey, Alix. Thanks for having me on. It looks like, when you go big whale hunting, and you miss those whales, you're going to miss results, right? They essentially miss sales by about $1 billion versus the midpoint of their guidance. And the fact of the matter is these AI deals are monster deals. That's why I'm saying it's big whale hunting. 100,000 GPU cluster that XAI or OpenAI, those are $3.5 billion deals. So if you miss on, one or two of these, that accounts for easily $1 billion.
So, Wooj, is this a super microcomputer specific issue, or is this big tech spending kind of slowing down here?
Well, it's a product transition issue, right? So if we look at the NVIDIA GPUs, they transitioned over from the last generation, the Hopper series, to the next generation, the Blackwell series. And given the greater capacity and the better computational power, the customers were actually waiting for this for quite some time now, and now they're clamoring for it. So essentially, what customers appear to be doing is canceling their Hopper orders and moving over to Blackwell. Now, I will tell you, they weren't the only one that had this issue. HPE a couple of months ago, they missed their expectations primarily because of this product transition as well, and it's biting Supermicro now.
So based on that, the chip cycle is moving really fast for AI. So what's next after Blackwell? This is just going to keep happening and kind of rolling it downhill?
Yeah, I mean, it's still probably a couple of years before we start seeing the newer series of chips really ramping up. So we probably have a 2-year product cycle. Before we get to that, Alix, I mean, let's see how the cloud capex holds up in 26 and 27. But for now, right now we have a near-term product cycle issue for at least Supermicro and HPE.
Wooj, what are your companies, kind of the tech hardware companies, what are they saying about this whole tariff climate? What, is it going to be an issue for them?
Yes, well, we published an update to our tariff note, and surprisingly, they've actually done a good job navigating the tariff issue so far. I've had 3 companies report that's hardware related. There's a couple of things we need to take into consideration. One, a lot of them are outside of China in terms of the manufacturing scope, so the tariff impact is fairly minimal. Two, there's a lot of manufacturing that comes out of Mexico. So, because of the U.S., Mexico, and Canadian trade agreement, USMCA, they're exempt from tariffs. So if you have anything that's built out of Mexico or Canada, whatever's assembled there, you're exempt from tariffs. A lot of the companies that have reported, they're using your USMCA to their advantage to win deals. And three, and this was somewhat interesting to me. I had thought there would have been some pull-in deals because of tariff concerns in the second quarter. The guidance thus far, Western Digital, as well as Seagate, which manufactures hard drives, they don't see any pull-in deals. So the second half of the year, which was a concern of mine, we don't see we see actually smooth demand going into the second half.
In terms of spending from Supermicro's customers, I know we're in the product cycle part, but are we seeing any change in customer spend? Like maybe they're spending the same amount, but they're spending it in different areas, or are they holding spend altogether or pulling back?
Yeah, so and let me clarify who Supermicro sells to.
Yes, please.
They don't sell to the Metas or the Googles or the Amazon or the Microsofts of the world. I mean, there's some of that, but the bulk of their spend goes to Tesla, Musk's XAI, or the CoreWeaves of the world. This classification of neo clouds, and for all intent and purposes, it seems as if they're spending. They're maintaining their level of spend. They're not spending more. The one overhang or one concern that I do have is because of the tariff issue so far, if they're not going to spend more, are they going to buy less, right? Because of the increase in tariffs. Now, if I'm right, we shouldn't see that much of a price increase from the server vendors or the GPU vendors because of some of the ways that they can avoid the tariffs. And spending should be okay into the second half. And if the Blackwell cycle works out for them, Supermicro should get back some of the lost sales.
So prior to 3 months ago, all we were talking about in the marketplace, broadly defined, was AI. Now I've gone 3 months really without really talking about AI because it's all about tariffs. Have your clients are they still as enthusiastic about the real opportunities for a transformation in technology coming from AI? Is that still on the front burner?
Well, so again, I'm gonna bifurcate that from the cloud guys and as well as the enterprise guys. From the cloud perspective, they are continuing to spend, right? If anything, there's a lot more excitement to spend, primarily because of some of these smaller language models, like a DeepSeek. Oh, we have a blackout. Like a DeepSeek.
Oh boy!
Right.
The studio light went out. Just for those of you on radio, studio light went out
Yes.
on Jin Ho. There is no broad blackout.
He's not in Spain or Portugal.
Go ahead.
Yes, like a DeepSeek, or they are looking for thinner models. If anything, there's going to be higher demand for some of the products itself altogether. So there actually is a lot of excitement. Now, on the enterprise side, if anything, there might be a pause on the enterprise side because of the high cost of acquisition. So the cycles for AI adoption may be more on 2020, later in 2026 and into 2027 versus the second half of this year and into 2026 on the enterprise side.
All right, Wooj, thanks a lot. Jin Ho, Bloomberg Intelligence Senior Technology Analyst in the dark, but helping us illuminate what we're seeing when it comes to some tech names like Supermicro.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Caterpillar down by about 0.5%, looking at slightly lower sales this year if the Trump administration tariffs remain in place. That's including an economy that dips into a recession in the second half. Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst, joins us now. Chris, how do you look at this company then when there's like a huge variable that will throw off its earnings for the rest of the year?
Yeah, so I think the release really isn't as bad as initially feared, and there's actually a number of positive takeaways here. The quarter was weak, and we knew that going in. Volumes were going to be down, pricing was going to be under pressure, but the outlook is actually better than I think many had anticipated. Their 2Q sales guide was actually above the street, We saw backlog improve to a record $35 billion. Orders were up double digits, both year over year and sequentially. And really, if you look at their outlook ex tariffs, it was really better than what they had expected prior. So, and the tariff impact as of now at least appears manageable. So I think the release, should at least help allay some of those concerns over a more pronounced slowdown this year.
Chris, does Caterpillar build their equipment in the U.S.? Is that where the manufacturing is, or how do they do that?
Short answer, they build everywhere.
Okay.
They are a net exporter out of the U.S., but you have to remember, this is a large global manufacturer. They have manufacturing footprint and supply base that really spans the globe. But if we're thinking about net exports, yes, they export more out of the U.S. than they do import. From a revenue perspective, the U.S. is almost half their revenue today.
What about for its peers? What does this mean for some of its peers and the trading environment that they were previously in?
Yeah, so at least for some of the domestic U.S.-based manufacturers, I think this is maybe a little bit of a sigh of relief. By no means are we out of the woods yet, but it certainly seems that the tariffs, as of least how they stand right now, are somewhat manageable. Cat's expecting a net cost headwind of about $250 to $350 million next quarter. If you kind of extrapolate that out over the balance of the year, you're talking, maybe somewhere in the 150 basis point headwind to margins. But that may even prove, overly pessimistic because, Cat's still evaluating and implementing some of these mitigation actions. So we could even see that come down from here.
I was kind of surprised, I guess positively, Chris, that their backlog looks pretty darn good. It's not like their customers are canceling orders or anything.
No, and it's a record backlog, right?
Yep.
So, we have coverage, if you look at consensus revenue, whether we call it flat or down slightly this year, they've got coverage for, nearly 70% of the year already. So I think that does help provide some kind of buffer. There was a concern out there that do we see this pre-buy, ahead of some of the tariff implementation? And Cat really kind of downplayed that. And in conversations they're having with their dealers and with their customers, they're really not seeing any evidence of that. So yeah, these do seem like, true orders and really a really healthy backlog, which, I think helps support, that flattish type revenue outlook that they're putting out there.
All right. Thanks a lot, Chris. Really appreciate it. Chris Ciolino, Bloomberg Intelligence Senior U.S. Machinery Analyst.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Let's get back to these markets. We have a sell-off. We are off the lows of the morning. The S&P's off 82 points. That's 1.5%. Anne Maletti joins us here. Old buddy of mine. We've been into business a long time. She's head of equity investments at Offspring Global Investments. Dude, you're grinding it. Still working hard. Anne Maletti joins us here in studio. And you and your colleagues at Offspring, I mean, a lot of folks that have been in the market for a while, you've seen, lots of different markets, whether it's the dot-com bust or the financial crisis or the pandemic. Got a little bit of uncertainty here this year in the market. How are you guys thinking about some of the volatility we're seeing in a lot of these markets?
Yeah, I mean, I think, Paul, you're right. There's when you have moments like this, you kind of always look back and you look at what rhymes to the past. And, even during COVID, that was something we never lived through before. So while history does kind of rhyme, it never perfectly repeats itself. And here we are again in something we've never lived through before. But there are lessons from the past that you definitely take forward. And some of those lessons really are like, look, in the moment, it feels awful and uncomfortable. But history does suggest that equity market returns for those who stay invested and really think about bottom-up fundamentals and companies that really can control their own destiny. Those investors do well over a cycle. And so that's what our investment teams are focused on, looking at trying to take advantage of emotion and take advantage of uncertainty and volatility.
So is that on a sector level, an index level, or a stock-specific level?
It's more on, from a bottom-up stock selection basis. And, there certainly are, depending on the environment, different industries that might fare better than others. But I would say even within almost any industry, there are going to be companies that do better than others.
How do your portfolio managers, how do your analysts, assess a company when a lot of times these companies are coming on their conference calls and saying, we're withdrawing guidance or we can't give guidance because we don't know what's happening in our business. Boy, if they don't know, how are investors supposed to know?
Yeah. I mean, Paul, this is something you spent a lot of your career doing, and our teams do too. So while the calls are critically important, as you know, kind of during reporting season, most of the past is the past. We're not focused on that. We're focused on going forward. And on the calls, they may not be able to give guidance. But if you know that company really well, and our teams do have deep expertise in fundamental research, they understand the model, and they can kind of walk through with the management teams, where do they have levers to pull if things get worse or if things get better, and how quickly can those levers be pulled? And then asking them the same question you asked me. How do you look at this environment versus other environments? How can you manage through those? And understanding where they have control of their own destiny versus where macro can kind of push them is really, really important. And you will see some companies actually do have more control in this environment than others.
What do you do about finding safety in the middle of that, right? Like in other cycles, you can make an argument that maybe the dollar or treasury market, it's okay to hide out there a little bit. Is that still the case? Do you guys see that Mark Mobius says like all his funds are like 95% in cash?
Is that right? Wow.
Yeah.
Yeah. Look, I think we tend to be and think about being invested for the long term. And, look, I manage our equity business, our fixed income team. They believe it's a good time for fixed income too, focusing on the income component of that. But on the equity side, you got to be right twice if you're going to sell and then predict when is the right timing to come back. And again, history would suggest that if you just wait out these periods and stay invested, you're going to do better in the long run.
I never thought I'd be talking to you about this topic, because usually Anna and I talk about radio stocks, TV stocks, billboard companies, those kinds of back in the day.
Billboard companies, what's that? No, I'm
Great
kidding.
business, by the way. You can't fast forward through a billboard. Just remember that.
Especially if you're stuck in traffic. Yeah.
Exactly. Emerging markets. How do you guys approach emerging markets?
I think, we're lucky. We have two great emerging markets teams. One that has a focus on providing income along with the equity returns. So equity and income focused. And the other one that's a little bit more kind of focused on more growth at a reasonable price and a little bit more emerging market like with real growth behind it. And so in this environment, you are seeing a natural lift to EM. And I think it's because obviously the weakness in the dollar has propelled those markets. Again, we kind of predicted that in our outlook piece in October, that whether we saw dollar weakness, we might see the strength of other currencies happen. And investors have been long underallocated in emerging markets. So you're seeing kind of a natural lift in some of those areas with real opportunity. The other thing I would say, Paul, is it's pretty apparent that we're kind of tapped out on the fiscal spend here in the U.S. There's a lot of other countries that have the ability to really spend.
So do you guys like hang out all the time and like talk about stocks or like
back
what?
in the day when we go on conferences, you get the cool kids would go to a certain table,
Oh, okay. And then if they're not cool, you're like, no thanks.
Yeah,
Take your non-billboard stocks and go away.
I have a chat group of former media analysts on Wall Street.
Oh, fun.
And all these, Drew Marcus says hi, Rich Rosenstein says hi,
Yes.
Victor Miller says hi.
There we go. Name dropping.
Yeah, I'm dropping. I mean,
Flexing.
they all know Ann Maletti. So I said she's in my studio on my show. How cool is that?
That's really cool.
Yeah.
They were the all-stars back in the day. I was the little kid on the block.
No,
for sure.
don't say that. Please. All right, Ann, thanks a lot. Well, you can tag her out.
Yeah, Ann Maletti, head of equity investment. Is this a new role for you?
No, about 5 years.
Oh, okay.
Yeah.
All right. Pay attention. She's always like the media analyst that's strong. Ann Maletti, head of equity investments, Offspring Global Investments, joining us live here on our Bloomberg Interactive Brokers. We appreciate getting a few minutes of your time.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.